Good morning. It's Tuesday morning, the 6th of October. I'm Greg McKenna, and here's my Tuesday morning market wrap. It's been a big night, a big couple of days for stocks. So we had a public holiday in Sydney, New South Wales yesterday. So we didn't do a video. Since then, since the last update on Friday, stocks in the US are up about 3%. Stocks in the UK and Europe, 4% or so. It's been a really, really strong return to positivity from the market. A lot of that was obviously because of non-farm payrolls last Friday night. Not only were they weak at 142,000 against a market expectation of over 200,000, but the August numbers, which everybody expected to be revised up, were revised down by 37,000. So that really changed, and the fact that wages didn't grow the way that people thought they would, that's really changed people's view about when the Fed is going to be able to justify a tightening. Obviously, October's probably off the table now with that non-farm. We've got lots of Fed speakers last week. We had Rosengren from Boston over the past 24 hours saying a rate hike still on the table. But realistically now, you have to think that we're looking sometime in early 2016. Interestingly, if they don't go December, which increasingly they may not, then as we get into 2016, it becomes possibly more problematic because of the presidential election. But we'll have to see how that goes. Now, of course, weaker stocks, weaker employment might, along with weaker PMIs, still really weak. So services are looking okay, but weaker in the US, in Australia, and around the world. Manufacturing PMIs, except for Australia, are not that strong. So you're really getting a sense that the sweet spot that the global economy was going through maybe 6 or 9 months ago might have passed. Now, we know that IMF's downgrading growth, everyone's downgrading growth, that kind of thing. Why are stocks up? Now, there's been column inches after column inches already written about, you know, the bad news is good news meme has suddenly come back. But let's think about this from a market point of view. We don't care about the rhetoric. We care about the price action. And what has the price action over the past month told us? It's told us that the August lows were strong. It's told us that except for the DAX and except for the Canadian dollar of the markets I watch, most everything else held above those August lows during September. Sure, they looked weak, but they still held. Oil in particular didn't even break down through the bottom of the recent trading range like a lot of other markets did. So that told me already last week, as we were coming to the end of September, that the market was starting to get set up for a reversal. You then look at your charts, you look at your weekly charts, you look at your monthly charts, those sorts of things, and you see a pattern, or a situation, I should say, that just screams reversal. So if I have a look at my, I'll just show you the chart here. Here's the S&P. This is the global bellwether. All right. So we've got the S&P 500. The 2014 low was a little bit below the 2015 low, as we've seen so far. We had a nice bounce. This is a weekly chart. We've had a nice bounce. We've had a bit of volatility, but we couldn't take out this low. Now, it was different in the DAX. The DAX did manage to take out the low, but only for a second, and then it quickly reversed away. If we have a look at oil, right, along here, we've just had consistently, we've had that bottom hold in. Now, it hasn't broken out at the top, so I'm not getting excited either way, because oil not breaking down told me that there was lots of intra-market moves, but the structure of markets hadn't broken down. And oil not breaking up tells me not to get too excited. But if we have a look at the ASX, it's broken up and is going to hit some interesting resistance in the next, today probably. So if you have a look, this 52.30 region is going to be resistance today. And then, of course, up here at this 5,300 region, 52.70 to 5,300-ish is going to be solid resistance for the market. But overall, the way that my systems work is I look at this combination of my Jimmy R's, the 15 and the 30 moving average. I look at my MACDs, and then I form a judgment. I'm always trying to buy close to the point of exhaustion. But if I have a look at that on the dailies, And certainly if I have a look at that on the weeklies, that suggests to me we'll probably see a move to this 300 region, possibly pull up there, maybe pull back. And over the course of the next month, we might even see it up at 5,400, possibly higher. So why has, what's changed? The reality is that all that's changed is that, yes, people like it makes sense. But what's really happened is we're just seeing a snapback. I would argue that that chart that I showed you a little bit earlier of the S&P 500 is really just the S&P 500 topping out. And we talked about that last week. So from my point of view, in many ways, I'm agnostic about this move. I'm going to trade it. You know, it's probably got a little bit of legs in it yet. But overall, my overall view, and I'm still 100% cash in my super, is that after this next rally, then we'll start to see some weakness again. Now, the interesting thing is that the Fed is really getting itself into a bind now. So it'll be interesting to see if they can manage to walk their way through that and see how that works out. Now, of course, if the stocks are starting to look better, and we've had the CRB rally 1.17% last night, and it's starting to look a little bit better. We've got the Aussie dollar having made a sort of a double bottom in that 69 a low region last week after having made a low of 68.70. You know, can it get back up to 72 cents, 73 cents? I think it can. I think it can over the next few weeks. Can it get much through there? I'm not sure. But we could have a nice little double bottom here. Now, of course, it depends on what the Reserve Bank does today. No one's really tipping a rate fall today, but of course, anything could happen depending on what they have to say about things today. So overall, this risk on meme, and I hate to use that term, but let's face it, that's what's going on. Everyone's buying stocks again. They're bidding commodities again. Gold stopped. Crude's up a little bit. Gold stopped being useless again. The Canadian dollar's back under 131. That's got to tell you something. The Kiwi's back up near 75. The bid tones come out of the euro. The bid tones come out of dollar yen. All of these kind of things tell you that the market is favouring, looking for a reason to be positive for a bit. Now, of course, that can change really quickly. We're still in only the second week of the month, and there'll be lots of data over the course of this week and next. But from my point of view, I think that we're going through a period now where markets have found a bottom. They've roughly retested it in September. Now they want to find out where resistance is. Now, as I said, 5270 to 5300 in the ASX. We know that there's a lot of resistance in that 72.70 to 73 cent region for the Aussie dollar. Those kind of things. So these are the big levels to watch on the S&P 500 on a weekly basis. My sense is that we've got resistance in this 2005 to 2020 region. If it can get through there, maybe it can run on. But there's lots of wood to chop going higher. This is a counter trend rally. It's not one to get rhetorically angry about, as some commentators are. It's just the market. It's just trading. As traders, we should always be agnostic about how things are going to play out. So that's they're the key for me today. The ASX to go a little bit higher, S&P to continue to rally over a kind of a multi-week basis. Watch oil. If oil breaks out, if this Russia talking to OPEC and OPEC trying to get the band back together and push prices higher, then you're going to see a reversal. You're going to see bonds start to rise. And Friday night, US 10 years finished below 2%, 199. They're up 5 or 6 points. That's no big deal. But if oil can break out, we see 47 trading, 48 trading, heaven forbid 50 trading, then a lot of what the Fed is saying about inflation being transient again will start to have some sort of basis in fact. And if we see oil crude going, we'll probably see, Dr. Copper's up at 236. So it's bounced a little bit. But the most important thing to remember, this is topside volatility. There's lots of hand wringing when we saw downside volatility. We've seen topside volatility here. They're still the same coin, just different sides. We're still in that pattern of uncertainty, and you're still going to see some fractious moves. Overall, I favour a test higher to find resistance before we head back lower. How long that test takes, I'm not sure. It could be a few days to a few weeks, but overall, I'm still, overall negative. But that's rhetorical as opposed to just trading for the moment. I'm running with the bulls until I get to the levels where my systems tell me it's time to lighten the load. So it's going to be an interesting week. It's going to still be volatile. We'll get more 1% up days and probably a few 1% down days. But it's fun. These are the best markets. Just make sure, as I always do, frame your position sizing and your risk to the volatility in the market. That means at the moment smaller position sizes. It also probably means bigger stops. In some cases, I'd probably trade smaller positions with bigger stops. Some people might trade with tighter stops. Just depends on what your approach is. But anyway, that's it from me today. I'll be back tomorrow morning, Wednesday. So have a great day. Stay safe and good trading. Bye for now.